Hi, and welcome back to the Food Fund, where we analyze investing in food stocks. If you love food and love buying food stocks, beverage stocks, and restaurant stocks, you will love this channel. In this video we will be analyzing if Wingstop stock is a buy. Wingstop, stock ticker symbol WING, is just one of many companies we explore on this channel. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Wingstop. Wingstop was founded in 1994 in Texas and quickly became a popular chicken wing restaurant. In addition to their namesake chicken wings, the restaurant also offers boneless wings, tenders, sides like fries and fried cheese, and of course, their signature sauces. From the fiery atomic to the classic lemon pepper, there's a flavor for every wing enthusiast. In 2015 the company went public, which marked a significant step in their growth journey. Today the company has grown to over 1,400 restaurants in more than 30 countries, relying on a dedicated team of over 20,000 employees, working hard to deliver that signature flavor experience. Now let's look at the price action. Starting with the 1-year chart, we see that Wingstop had a CAGR of about 77%. Zooming out to the 5-year chart, we see that Wingstop had a CAGR of 34%. These are astronomical gains. This company is awesome. If we perform a backtest comparison of investing $10,000 in Wingstop versus the S&P 500, we find some positive results for Wingstop. In that comparison with the S&P 500, $10,000 invested in Wingstop would have grown to $48,241, or a 36% CAGR, versus $20,979 or an 16% CAGR if invested in the S&P 500. This demonstrates tremendous outperformance for Wingstop. And surprisingly, a Wingstop investment would have been more volatile with a 53% standard deviation versus 18% for the S&P 500. Wingstop outperformed the S&P 500 in terms of the best year performance, for which Wingstop grew 87% versus S&P 500 31%, and outperformed on worst year performance, where Wingstop fell only 17% versus the S&P 500 18% fall. In terms of max drawdown, Wingstop fell 55%, the same max drawdown as the 24% drawdown for the S&P 500. While Wingstop did matched performance with the S&P 500 in comparisons using the Sharpe ratio, it outperformed using the Sortino ratio. Now let's hop over to market share and take a look at Wingstop's market share. In this newest version of market share, we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under restaurants and see that Wingstop is categorized as a fast food restaurant. Expanding the fast food restaurant tab, we can see that Wingstop is the smallest company by market share but is growing. Let's look closer at the year-by-year changes in market share. So we come over here and type in the ticker symbol for Wingstop and see that the market share is 0.04% out of the publicly traded food, beverage, and restaurant stocks currently in the market. Wingstop is tiny and has a lot of room to grow. The 5-year market share CAGR for Wingstop is 14%. Wingstop's market share has been expanding over time. If we start in 2019, we see that the market share was 0.026%, 0.032% in 2020, 0.031% in 2021, 0.036% in 2022, and rose to 0.043% over the trailing 12 months. Clearly Wingstop is steadily grabbing market share from larger players. Let's take a look at the fundamentals. Gross margin is 48%. This is a good gross margin. Revenue has compounded at around 23% over the past 5 years and has reached over $438 million most recently. People love wings. Looking at cash flow, we see a 31% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 11% CAGR. As a result, free cash flow has exploded at a 50% CAGR. This is so beautiful. We have covered many restaurants on this channel, and it is just so refreshing to see a company with not only positive operating cash flow but positive free cash flow. And it is growing at a tremendous rate. Weighted average shares outstanding have grown over the last 5 years, going from 29.7 million shares in 2019 to 30 million shares most recently. Wingstop has been diluting shareholders ever so slightly. The good news here is that the rate of dilution is so small it is negligible, with the share count rising about 0.27% per year. I think the days of massive shareholder dilution are behind us. Now let's view return on invested capital. Return on invested capital has risen from 26% in 2019 to 36% in 2023. This is a very good sign. Management has actually gotten more efficient in running the business over time. So far this company is firing on all cylinders. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from -1 days in 2019 to -3 days most recently, Wingstop has gotten a bit more efficient over time. Love to see negative cash conversion cycle values. Now, let's look at Wingstop's debt. The net debt to EBITDA has fallen over the past 5 years, going from 6.4 in 2019 to 5 most recently. This is a fair amount of debt, but they have been steadily paying it down. Last, let's explore dividends. Current dividend yield is a tiny 0.3% with a dividend payout ratio of 34%. This means that their dividend practice should be sustainable. Dividends per share for this company have grown at an 21.4% dividend per share CAGR over the past 5 years and a 5.5% dividend per share CAGR over the past 10 years. Wingstop's dividend per share growth has accelerated as shareholder dilution slowed. The fundamentals of Wingstop are very good. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. We are now on track to hit 1,000 subscribers this year, so please subscribe, share, and like our videos. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Wingstop. It is a restaurant company with a gross margin of 48%. The 5-year revenue per share CAGR is 23% and the 5-year free cash flow per share CAGR is 49%. Again, this is so good. A return on invested capital of 36% is amazing and growing. Next, the cash conversion cycle of -3 days is great. As long as this value is negative, I am happy. Concerning debt, a net debt to EBITDA of 5 means that it would take Wingstop just 5 years of earnings to pay back their debt. This is a lot more debt than I would like, but otherwise from a fundamental standpoint, Wingstop is like the best company ever. Now let's switch our attention over to valuation. Wingstop is overvalued relative to the S&P 500 with a ratio of 4.6. The price to earnings growth, or PEG ratio, is 6.1, indicating that Wingstop is overvalued relative to their projected earnings growth. While the fundamentals for Wingstop are nearly perfect, the valuation continues to be lofty. Great growth companies often demand a premium for their performance. I think Wingstop is no different. It is an excellent company. From here it is really just about finding good pullbacks to start or build a position. In the meantime, the company will continue to pay down its debt, improving its fundamentals even more. For me, Wingstop is for sure going on the watch list. Many thanks for watching. What do you think about Wingstop and their massive growth? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.